Here they come. Hello, everyone. Welcome. Welcome. I know everyone's connecting to their sound and getting settled. So welcome. My name is Vicki Storage, and I am Engagement Director at Alberta Ecotrust. And it's my pleasure to welcome you today to our environmental gathering. I'm just going to set the scene a little bit, and then we'll move into the discussion. Welcome. And just a few things about how we're going to use Zoom today, and some of the participation guidelines. So we are in meeting mode, so we can see each other. But we would just ask that you please mute yourself unless you're speaking, unless you're one of the speakers. And the way that we're going to be using for questions is the chat. So please feel free to put your questions as the speakers are speaking into the chat. And we're going to have some presentations, and then we're going to have a Q&A portion. So our host, Mike Mellross, will be looking in the chat to see your questions. Also, of course, we always ask that you lead with kindness and curiosity. We want to make this a great learning experience for everyone, so we want to make sure we say that. And a little change here. Normally, we haven't been recording these events, but we made the decision this morning to record this event. So it says, please note that the event isn't recorded, but it is indeed being recorded. So, so just to let you know about that. Just a few, we also want to make sure that we acknowledge the land that we are gathered on, even though this is a bit of a unique version of a gathering. Today, I am joining you from Mohkinstsis, which is also known as Calgary, which I'd like to respectfully acknowledge is the traditional territories of the Blackfoot and the people of the Treaty 7 region in southern Alberta. This includes the Siksika, the Piikani, the Kainai, the Tsuut'ina, and the Stoney Nakoda First Nations. And of course, the city of Calgary is also home to Métis Nation of Alberta Region 3. Alberta Ecotrust supports environmental projects in the treaty regions of 6, 7, and 8. And we have people zooming into this session from a range of places in different treaty and unceded territories. We want to welcome everyone. We recognize that it's not enough to acknowledge our traditional lands. We must also learn and honor the traditions and the people who were here before us, and also who will come after us. Reconciling the past and moving forward in ways that truly include and make space for our Indigenous friends and neighbors, as well as newcomers from other places, is important to us at Alberta Ecotrust. And what we do here is felt in many ways. So thank you for being here with us. And just a few words about Alberta Ecotrust. Many of you may know us, but in case you don't, Alberta Ecotrust is entering its 30th year in 2021. And we're guided by a vision of healthy ecosystems for all Albertans, and a mission to partner across boundaries to mobilize and inspire those who champion and protect the environment. The environmental gathering is one of the ways that we do that. The environmental gathering is now in its 5th year. Normally we spend 2 days in the same place together, eating and discussing and sharing. This year, of course, we shifted things. And so it's been a series of asynchronous programming over the last few months. And we're very, very proud that we've invited 500 plus registered attendees to hear 37 speakers over 15 different events. So we're really proud of it. And this is indeed the final event of the series. So we're really happy to have you here with us here today. And the goals have been the same. We still want to share ideas. We want to celebrate success stories, and we want to build community in Alberta's environmental sector. And we certainly couldn't do any of this without our sponsors. So thank you to the sponsors of the environmental gathering. And we want to give a special shout out to Vancity Community Investment Bank, who are supporting this discussion in particular. So thank you very much to them. We've had a few different programming pathways through the environmental gathering, and Idea Talks is one of them. Idea Talks is big thinkers bringing us big ideas. And here are our big thinkers today here. Financing clean energy innovation is certainly something that we're thinking a lot about at Alberta Ecotrust. And with the urgency of climate change and the scale of the systems at play, this may be one of the biggest ideas that we explore in the environmental gathering this year. And so with our Climate Innovation Fund coming up, Alberta Ecotrust is very focused on these discussions. And I'm going to hand it over to Mike Mellross, my colleague, Alberta Ecotrust's Program Director of our Climate Innovation Fund, to take it from here and start the discussion. Mike?
Thank you, Vicki. Hopefully everyone can hear me okay. I'm basically going to kick us off. We've designed our panel a little bit to take you on a journey, I think. I'm going to set the stage with respect to the Climate Innovation Fund and kind of the high level policy environment of which we're trying to promote, scale up, and accelerate low carbon financing. Thor's going to talk a little bit more about some of the sort of approaches and mechanisms and issues and barriers. And Jonathan from Vancity is going to talk about really some on the ground examples of low carbon financing. But we don't want to just talk at you. We're going to have some pretty brief presentations from each of the panelists. And then we will have some opportunity for questions from all of you. And if you could put those into the chat, I'll try to collate those while the other speakers are speaking, and we'll be able to answer them as we move forward with the agenda today. So I'm going to start us off a little bit with talking about the Climate Innovation Fund. So Vicki, if you could advance to the next slide, please. So what is the Climate Innovation Fund? The Climate Innovation Fund is a new programmatic element within Alberta Ecotrust. We operate in Calgary and Edmonton, and it's essentially a $40+ million fund managed by Alberta Ecotrust with the primary objective of deploying the funds to unlock deep emissions reductions in Calgary and Edmonton. And we couldn't do this without our seed funding from the Government of Canada, Natural Resources Canada, and our valued partnership with the Federation of Canadian Municipalities. Next slide, please. Alberta Ecotrust is a low carbon cities Canada center. And what that is a pan-Canadian network of 7 centers across the country, coast to coast, with Vancouver being the one on the west coast. Edmonton and Calgary, we have 2 in Alberta, really 2 hubs. The Greater Toronto and Hamilton area, Ottawa, Montreal Metropolitan Community, and the Halifax region. And together we work as a network to advance thinking around low carbon solutions and low carbon financing. And we can move forward as a body and a network that works on solutions with our coalescing body, the FCM, or Federation of Canadian Municipalities. Next slide, please. One thing the LC3s acknowledge is that cities are critical to achieving climate targets. Here in Alberta, our cities make up about 25 to 30% of the greenhouse gas emissions. Differs a little bit from the rest of the country, whereas our cities actually make up 60+ percentage of the emissions. Not surprising in Alberta, we have a large industrial base with the oil and gas sector. But the critical thing is that Canada cannot reach its climate goals without taking action in cities. And that's really what the Low Carbon Cities Canada Network is about, and the Climate Innovation Fund. Next slide, please. So when you hear $40 million+ sounds like a ton of money to me personally, but really, what does this look like on the ground? It's a bit more modest, but nonetheless, through targeted investments, we really think that we'll be able to move the market and advance the low carbon agenda. So what it really looks like is about $1 million a year in programming and grants in Calgary and Edmonton. And then the exciting piece too is we can mobilize the capital within the endowment for the purposes of direct investing into technologies that reduce emissions in the 2 cities in which we operate. So we hope to be able to start up our direct investing arm in 2022. We're getting ready for that in 2021 with a targeted allocation of about 10% of the endowment being used for things like debt financing or potentially an equity stake, but likely debt financing in some way for low carbon projects. Next slide, please. In order to deploy the funds, we have buckets or elements of programming that we intend to undertake. One of those is strategic projects and programming within Alberta Ecotrust itself. So things that we can do internally, it could be innovation labs, it could be policy papers, establishing partnerships and convening groups to discuss complex issues, that type of thing. Well, we're going to build on our strength here at Alberta Ecotrust, being an environmental grantor for the last 30 years. We're going to have a granting arm of the Climate Innovation Fund. That's going to include everything from grants to not-for-profits and charitable organizations, and through intermediaries, business associations, and potentially even private enterprise. And then I talked about our direct investment arm, where we're going to be mobilizing the capital within our endowment. Our focus areas, after a pretty significant engagement effort, we've landed on 3 focus areas. And really what we're doing here is we're following the carbon. We look at the emissions profiles in Calgary and Edmonton, and we see where the most greenhouse gas emissions are being produced. And we've bucketed those into 3 areas. One is building better and retrofitting wiser. Not surprising, the building sector, both new and existing. Likely in early years, focusing on retrofitting, because that's going to be a big challenge over the next decade. Moving on mobility, which includes active transportation, as well as low and no emissions vehicles. And then our final focus area is decarbonization and renewable energy. This would be programs and investments that support renewable energy, but also things we can do to decarbonize the current fuel that we use. This can take us into the realm of hydrogen, renewable natural gas. Also, it can mean building level carbon capture and storage and utilization, and even programs and investments that plug into this idea of creating tradable instruments from the accrued carbon benefit for the purposes of offsetting. There's a lot of work in artificial intelligence and machine learning on aggregating environmental attributes. This is an area where we think we can put some effort in as well. Next slide, please. When we talk about low carbon financing, really what is that? This is a definition from a report a bunch of smart people gave the federal government in 2019 on sustainable financing. And low carbon finance is a variety of financial policy, financial systems, financial technology, products and services that promote the development of low carbon economy. And essentially what we would like to see is that low carbon financing just becomes financing, because we want our economy to become a low carbon economy, just like we would want our financing systems to just become our not low carbon financing systems, but just how we finance and how we do work. Next slide, please. So given that we're in early days with the Climate Innovation Fund, we've been giving a lot of thought on defining our role in low carbon financing. We certainly haven't come to all of the conclusions on this. Welcome to a lot of ideas and advice still going forward. But some initial thoughts is where we can work is things like generating the imperative. You're not going to attract capital flows and low carbon financing if there is no need for change, no created imperative or final end goal. So often generating the imperative means policy, regulations, consistent price signals. And there's a role that we can play at Alberta Ecotrust in advancing some of the thoughts around policy at the local level and potentially even the provincial level, and aligning all of the stars when it comes to sort of the federal goals on climate change. How does that translate to the local level? Work with the market to make investments financeable. So some of those things we talk about is aggregating opportunities. Often these distributed investments aren't enough for large capital providers to bend down and pick up. So how do we take the $1 million deal and make it into the $150 million portfolio? So working with our partners, how do we get to that point? Some of the ideas around that is, industrialization of energy efficiency retrofits and some of the Internet of Things ideas in identifying opportunities and aggregating those opportunities. We can look at de-risking as well, loan loss guarantees, being an early mover. What is our role in potentially a capital stack where we can provide concessionary funding? As I mentioned, monetizing that carbon benefit, supporting the transformation of the carbon benefit into a tradable instrument. Another potential bucket of work we can focus on is supporting capacity building. For sure, where we need to build capacity in the climate solutions sector and understanding what low carbon financing is, but also bring up the entire financial sector and what are things that we can do to help support and deploy innovative financial products and systems. We can build and test these mechanisms, work with our partners to build the entire ecosystem. Next slide, please, Vicki. And when I talk about the entire ecosystem, financing doesn't occur in isolation. It is one piece of an ecosystem that we need to get right. If we're going to scale up these ideas, if we're going to make them market norms, taking the novel to the norm, we really need to educate the market. We need to build capacity across sectors. And there's a number of pillars that need to be in place and working in concert together, including some of the things I've already talked about, like the imperative, and then this opportunity identification and aggregation. Then those incentives and financing tools can be plugged in. But we also need to focus on project development and technology innovation and project management, getting our industry up to speed on retrofitting and how machine learning helps us manage our energy better, those types of things. And then of course, there's the repayment of the financing and then monitoring and reporting on the financial outcomes, but also the environmental, social, and governance outcomes. Next slide, please, Vicki. I'm going to end it here on this slide before I introduce our next speaker, but just giving you an idea of the scale and the velocity of change that's required. Edmonton has done some pretty incredible modeling work. Calgary has also done some intensive work with the University of Leeds of a similar ilk. But just to give you an idea of what Edmonton landed on with the potential incremental investment required in order to achieve deep carbon reductions. And this means taking per capita carbon footprint of about 17 to 19 tons per person down to about 3 tons per person within a decade. It's a significant monumental effort. And the required investment, according to their modeling, is about $1.1 billion incremental per year. Now, when you say $1 billion, it sounds like a lot of money, but putting it in perspective of GDP, it's about 1 to 2% of Edmonton's GDP, which is projected to be about $92 billion in 2020. And that's a significantly lower GDP than we've seen in other years, given the pandemic. And when it comes to the building sector alone, there's an expectation that $180 million a year would be spent incrementally above what's already spent in order to achieve emissions reductions in line with that deep carbon reduction goal. But again, putting that into perspective, Altus does a renovations report every year, and they estimate about $6 billion of renovations occurs annually in Alberta. And really that's all financed right now. It's financed through conventional financing in some way. So how do we make sure that the energy efficiency components are also financed within that particular financing mechanism in Alberta, that incremental 180 million? So that's the end of my slide deck. I think really what I'll do is just slide into introducing our next speaker, which is Thor. And Thor Jensen is a specialist in low carbon finance for the built environment. He holds an interdisciplinary PhD in economics, resource management, and environmental sciences. His postdoctoral research examined the transferability of green investment banks in the Canadian context. And Thor actually also sits on our investment committee for Alberta Ecotrust Climate Innovation Fund and acts as an advisor to the Social Innovation Academy. So with that, I will leave it to Thor to present. Thank you.
Thanks, Mike. This is probably going to feel like it's going to be a mile wide and a foot deep. But my first goal was just to position for you What's the role we anticipate low carbon finance is going to play from the perspective of building owners? What we ask it to do and what barriers it's supposed to overcome. And then I'd like to point to the elephant in the room, which is the problem of how come it's so hard to get out of the door. Walk you through another resource you can go back to outside this lecture to take this further, and then probably finish with maybe a bit of controversy, if I'm lucky. Next slide, Vicki. So this seems very basic, but I think it needs to be emphasized that whenever we're talking about finance or retrofits, we're usually talking about financial incentives. And we want to give a building owner financial support that's going to usually achieve around 4 things if we do it right. The first is it has to add value to the building. It seems simple to point out, but nobody does a deep retrofit if the building's going to be worth less afterwards. The deep retrofit, any retrofit's always going to be subordinate to the greater value of that building. You know, you bought it, plan to sell it for more in 5 years' time. Otherwise, you're just putting good money after bad. Ideally, we want to lower operating costs. This motivates a lot of people to do renovations, but you won't get this unless you get the first point, right? You really won't. And then thirdly, we don't want building owners, especially during a recession, to need to spend a lot of their cash out of their own pocket. It's very difficult for building owners when they're worried about vacancy and losing leases to actually put more money into these assets. So that's a real barrier for them. And then fourthly, there's specialized scenarios where we have a building owner who wants to undertake a renovation, but they don't have access to capital for a number of reasons. Next slide, Vicki, please. And some of those barriers, I'm sure you've heard them everywhere through the energy efficiency and renewable literature. These are things like split incentives or the landlord-tenant problem. If you have a commercial building owner and you have a triple net lease, it's the tenant who pays the utility bills. So the return on investment, even for a profitable energy efficiency measure, is always 0, unless equipment's failing and they have to keep it going. You've got the holding period concern. If you bought this building and you're planning to sell it in 5 years' time, you are less likely to want to undertake a 30-year investment in a facade, perhaps, unless it's attached to, again, point 1, adding value to the building. You have balance sheet constraints. This is more common in commercial real estate where you've got heavily levered property. You know, 70% of this is debt. And if they increase their debt levels by any amount, it's going to trigger a covenant, and then the bank's going to not let them do it. You have uncertainty. That's usually speaking toward, well, what happens when I actually make these improvements? Will I actually save energy? Will I be better off, or am I just paying you up front and walking away? And that's usually where performance guarantees step in. And then occasionally you have cost of capital. Sometimes people aren't able to access capital at a cheap rate. Next slide, Vicki. In Canada, historically, we almost entirely have relied upon government grants, past 20 years or so, I would say. And there's a few shortcomings with the approach. The first is it's usually only covering 1/3 of the cost. So if a grant is covering 1/3 of the cost, the other 70% or so, it's still coming out of the pocket of the developer, meaning they're not going to be wanting to even do this unless it's imminent. You can think about your own personal situation. Just because there's grants available or furnace rebates doesn't mean you throw out something new. You're only going to do it if you're on the last legs of this thing and it makes sense to do it sooner. And that is the only purpose of grants, to take things that are in the future and move them to now by 2 or 3 years for economic stimulus. And then the other problem is it doesn't really deal with those other issues I spoke about with respect to having a barrier towards borrowing. Next slide, Vicki. So low carbon finance, this is a bit of generalization, but designed correctly, it's the only thing we have that can really hit all 4 boxes. It can, done correctly, actually be worth more than a grant to the building owner because it can do a few things. You know, sometimes we can create cash flow for that building. We're making them more profitable without putting any money down. Done right, that is incredibly valuable to the equity investors in that building. Sometimes it allows them to increase their leverage without going after more expensive mezzanine financing or equity financing. It can lower their overall cost of capital in their stack, and that can really help them over several buildings. And it can stretch their investment horizon outside of that 5-year period or more that I was talking about. Next slide, Vicki. So then this is a bit of the challenge. Low carbon finance isn't new. I'm going to show you a few types of it, but this stuff has been kicking around since the 80s. Property tax financing, which we introduced in Alberta this year, or we're going to be maybe in 2021. That's been around since the last financial crisis. So I've got a picture here of Chair of the Canadian Infrastructure Bank, Michael Sabia, and he's basically saying capital is not the problem. Everybody wants to put money in these projects. We've never heard of a bank saying, sorry, guys, we can't invest more in the low carbon economy. We ran out of money. It doesn't really happen. And then on the right side here, what you've got here is this is commercial pace. And I'm showing this because this was in the United States and it took around 5 years to get to $100 million. So we've got lots of capital available. We have financial mechanisms which designed correctly can be worth more to a grant, to a building owner, and we can't get it out the door. And this is always something that's going to be frustrating our strategies for low carbon finance, especially now. You know, we're looking to bounce back from COVID-19 and rebuild green. But if we're copying things from the US, it's not going to be economic stimulus. So we have to be careful about our assumptions and think, are we going to be doing anything different? Where's the innovation going to have to occur? Because if we do what we've seen in the US, whether it's the utility bill or their performance contracts or their PACE programs, we're probably going to get the same result, but smaller by a factor of 10 because we're a population. Next slide, Vicki. So this is right off the Department of Energy's Better Building Solutions Center. The link is at the bottom. I wanted this for everyone to be able to go through here because you can click on all these boxes and you can open them up and you can see some examples and some explanations, and they'll tell you what they think they do in terms of overcoming investment barriers. What we're talking about here, when we talk about things like PACE, that coming in Alberta or SEEP, or utility bill financing, or all these other exciting things, we're over here in the specialized financing area. You can't see my cursor, sorry, but we're on the right side of the map. The left side of the map, traditional financing from the bank and leases, you know, that's what's happening right now for most of everything that's being financed. And then up on top, you have things that are like internally funded projects. If the government's been planning and it's got a plan to fix up this building in order, it's probably going to fund that itself, or they can go to the green bond markets. Next slide, Vicki. So I'm going to make some pretty gross generalizations here. I meant it when I said how you design these financing programs really determines the benefits they add and what they can and can't do. But I just want to give you some groupings for them. Starting with the top, you know, you've got green bonds. This is basically internally funded. This is something that QuadReal did, and that's the typo. It's actually $350 million. So one single REIT or commercial real estate investor in Canada did more than all the PACE financing in the US with one go. And this is really only available to people at a certain scale, these sort of investors who can go right to the public markets and bypass things and say, hey, I'm going to fix up my buildings according to this plan. And I forgot to mention, but the reason I've got revenue ceilings and floors here, it's going to help guide this because there are no restrictions on what this money is going to be invested in so long as it's green for QuadReal. It's got to be green, but this is going to be for things like community transportation, for water, for general sustainability, and not just things like energy savings. It has a very broad mandate painted onto it, and that's hugely advantageous. And there's no ceiling on this type of financing, but there definitely is a floor. You really won't hear anyone doing this type of financing or have this opportunity to do so unless they've already got the work figured out for over $100 million. I think the smallest I heard was 70 million, and it was really a proof of concept for a program in the US. So if we can drop down to the energy services, that's where you'll find the energy savings performance contracts, the Amerescos, the Johnson Controls. You know, General Electric used to have one. All the companies out there who offer, you know, services to the MUSH market, which is usually municipalities, universities, schools, and hospitals. These are public sector entities. And the reason they service them is because, well, you know, theoretically the government can borrow a lot, but they have to choose how to spend that money. And if it comes to funding services or fixing boilers, they're always going to fund services for people. So we get this deferred maintenance that stretches out over time and time and time until you have desperate school districts saying, please, we have to fix up all these buildings. It's starting to get really expensive. Then they put them all out to market and bid at the same time and they catch up. There's going to be this, there's both a ceiling and a floor on this as well. Ceiling is going to be energy savings. you know, even if we have an energy performance contract for 20 years, it's usually agreed upon that it's going to be, that you're going to have to recover the cost of that over a 20-year period. That's your limiting factor. And the floor is also going to be sized. These are sophisticated contracts. You do see a few at the building scale and sometimes by nonprofits and foundations and stuff, but usually these are $10 million and up to get into them. And then on the left here, we've got on-bill financing, property assessed clean energy. I like to speak about these often in the same breath because they have a lot of the same benefits to building owners, but they're usually designed very differently. Property assessed clean energy is we finance something, but we pay it back through property taxes instead of the building owner investing in it. With utility bill financing, the utility pays for it for the building owner and then collects it. It can be third-party finance, it can be financed by the utility, it can be on the meter, it can be off the meter. There's lots of variations therein. The biggest difference between these two is that you tend to find on-bill financing usually has a much narrower focus because it's really about meeting the mandates of the utility of that area. Their focus isn't necessarily to make sure you've got a passive home. It's more likely to make sure that you're not wasting too much energy during peak periods. So it just has a narrower scope. Property assessed clean energy, for commercial buildings at least, it usually is not bound by energy savings. It's a metric they report, but you can finance a seismic improvement, which has no energy payback, and it's still included in places like California. I would say though that, even for things like PACE, for commercial buildings, I think less than 20% of loans are less than $500,000 in size. And over half are more than $2.5 million. And you need 6 to 9 months to get approval because you need mortgage lender consent. So you still have that floor, which is saying you're really only going to chase after PACE if it's a project over $1 million. Coincidentally, our ceiling in Alberta is $1 million maximum. So a lot of projects that would find this worthwhile aren't going to participate. And then I'll just finish with energy services again, which is efficiency as a service. These are some of the newest things that are coming out for the past 5 years. And what's nice about them is they're not contracting based on energy savings. They're contracted to deliver you a service. So that could be delivery of heat, of light, of grid services. And this means you're not really limited necessarily by energy savings so much as the value of what you're delivering. And there's a lot of cool innovation in that space that maybe we'll have time to talk about at the end. And for the record, I wanted to show you, we actually are mapping this for Canada with Canada's Energy Efficiency Investor database with Canvas Impact and the Sauder School of Business, but it's not ready. But as soon as it is, and we've got the paper, I'll try and share it with you, and then you'll have a Canadian database to match with this type of hierarchy. Next slide, Vicki. Just for conversation, I thought it'd be fun. Financing gaps or railroad tracks. Normally when we say you don't have a type of finance, we assume it's a good idea, but oftentimes it fails because nobody built there because it was a terrible idea and nobody wanted that. One thing I'd like to point out is that energy efficiency has a very low ceiling. Energy is super cheap in Canada. It's very, very inexpensive, which means the amount we can finance and have it recovered with savings is very, very low. So if you go back to that map, if you have financial products that are chasing energy efficiency, you're not going to be able to finance very much. So maybe don't invest all your time and effort there. The other challenge with Canada is we have a low carbon grid. Unless you are in, fortunately, Alberta or Saskatchewan or New Brunswick, you've got very clean energy. And the challenge there is really to increase electricity, to increase the use of hydro and nuclear power. You can spend $1 million in Alberta to get the same carbon impact. In BC, you need to spend $40 million in energy efficiency. So it's not really a tool for most of the country. And potentially, what's more important, digitalization or energy efficiency? Digitalization is making sure that we are investing in technologies and buildings that are balancing our new grid demand when it comes online. We can talk about that in discussion more. And then I think that things like residential PACE seems to have a lot of promise, but it's going to be very challenging. Just because, as Mike pointed out, $6 billion in residential retrofits in Alberta, $60 billion across the country was spent last year. Residential financing is very, very competitive. And because if we don't have energy savings to support the loan, we really have to worry about the credit risk of that borrower, which means we're expecting residential PACE programs to be more efficient than banks at evaluating credit risk. And that's very hard to do because they're very good at it. I'm not beholden to this. It was just food for thought. Next slide, Vicki. I didn't want to just be critical and not leave you with anything positive or what I think that can do. These are a couple things that I think Alberta can do or the government can do within a year that would drive system-wide financial innovation. The first is something we could do just by changing a code. What this is, with the stroke of a pen, we've got class 43.1 and 43.2 accelerated depreciation. The tax credit. What it would enable us to do is offer energy efficiency services, things like hot water tanks, to be financed like you would a rooftop solar panel. Because what we have is we need to see people making investments in their home and their appliances that reduce energy, that can interact with the grid. And this would allow us to do it the same way you've seen rooftop solar done. And then here's something that Calgary and Edmonton can do that the government of Canada could not, which is a bit of a bold statement. I mean, the federal government has 37,000 buildings, but they're spread out. They're spread out all over the country. And what matters with some of these financial innovations is actually geographic proximity. So what I'm talking about here is the government of Calgary, and for example, with provincial buildings and federal buildings and university, actually has enough buildings in one location to start to invest in transactive energy services. What transactive energy services are is basically making sure that you're investing in the most efficient resource at the time, whether that's generation, renewables, or energy efficiency. Demand side response, batteries, EV charging, those can all play in the same market, but it has to be the same location because that's where the problems arise. And the beautiful thing about this is these are the types of technologies that we invested during the last financial crisis in 2009 in the US, for example. We might want to dust them up for our own financial crisis and say, well, we built them then, let's see if we can use them now and drive our own low carbon transition. And with that, I think I'm over my time, Mike and Vicki.
Thank you so much, Thor. That was a really good overview of barriers and some potential things to look at further. I'm going to introduce Jon right away. Jon is the Director of the Clean Energy Business Development at Vancity Community Investment Bank. And in that capacity, leads business development, deal origination, and relationship management for clean energy projects. Prior to Jon joining Vancity through the bank's acquisition of CoPower, Canada's first sustainable investment platform and a leading provider of financing to clean energy and energy efficiency projects. At CoPower, Jon served as a managing director and has been involved in a wide range of clean energy technologies across Canada that reduce greenhouse gas emissions and generate strong financial returns, including solar energy, energy efficiency retrofits, renewable natural gas, and combined heat and power, as well as energy storage. He is a recipient of the Canadian Solar Industries Association's Game Changer Award for Emerging Solar Leaders, and he is also on the National Low Carbon Cities Canada Advisory Committee. So with that, I'll hand it over to you, Jon, to give us a few words before we get into the Q&A.
Great. Thank you, Mike, and thanks, Vicki, and all the organizers for putting this together. I think Mike and Thor have done a really great job of teeing this up, and I really agree with the points they've made, and hopefully I can build on that. Very briefly, I just wanted to, next slide, please, let you know who Vancity Community Investment Bank is, and you can call us VCIB. And we're the only Canadian bank exclusively focused on financing organizations that drive social, economic, and environmental change. And as Mike mentioned, we recently acquired CoPower, which is Canada's first sustainable investment platform and a leading provider of financing to clean energy and efficiency projects. And if the name is familiar, Vancity, we are a subsidiary of Vancity Credit Union in BC, which has a 75-year history of being a values-based, community-first financial institution. We're also a member of the Global Alliance for Banking on Values and a certified B Corp. Next slide, please. So really our mission is to use the tools of finance to drive immediate and lasting social and environmental change in our communities. Our main areas of focus are social purpose real estate, clean energy financing, impact investing, and business banking. Next slide, please. Very quickly, I'll just mention two of our main investment products. And if you're interested in learning more about these, let me know and I can connect you with our capital investments team afterwards. But at a high level, we use these products to connect high impact projects with values aligned investors. This includes the CoPower green bonds, which are available to individual investors, and our VCIB impact GICs. Next slide, please. The main focus today, of course, is clean energy and efficiency financing, and the way we can do that in innovative ways. So with our experience, really, we focus on finding innovative solutions to get unique projects off the ground, built and scaled. We typically are working with developers and installers, asset owners and managers, building owners, community cooperatives, municipalities, and other government agencies. And we're interested in financing a wide range of technology classes, including but not limited to small-scale hydro, renewable energy and storage projects, geo-exchange heating and cooling, conservation projects, green buildings and retrofits, electric vehicle infrastructure, microgrids, and waste to energy. Next slide, please. So briefly, I wanted to go back to something that Thor had talked about in that chart from the US Department of Energy. So VCIB is very much playing on both sides of that chart. We have traditional financing products, and then what the clean energy team focuses on is predominantly that specialized financing. And even within that, it's often the that subset of energy services. So in project finance structures, typically this allows borrowers to take non-recourse senior secured debt at the project level. So we're often lending to a special purpose company that's sole purpose is to own and operate an energy project, be that an energy savings performance contract like the one Thor mentioned, or a PPA-backed solar project, for example. And in most cases, we're able to come in at construction financing. We can also provide short-term and bridge financing to help build and aggregate a portfolio of smaller projects. We can provide long-term financing or refinancing for operational projects. And we can support municipal or utility programs through on-bill or pay structures. We're generally looking for loan sizes of 1 to 50 million, and often can provide financing up to 60 to 80% of a project's capital cost, and in some cases up to 100%. Our rates are competitive depending on the risk profile, and we can often fix those rates for between 2 to 15 years with amortizations of up to 25 years or longer, which is obviously, which is often critical on these projects that have high upfront costs but longer paybacks, as Thor had mentioned. Next slide, please. I won't go through all of this, but this gives you a bit of a high level of the kinds of criteria we're looking for a project finance loan. So we're looking for projects that use well-established technologies, where the development team and operations and maintenance providers are experienced, where there's appropriate warranties and insurance in place, where the credit risk is moderate and mitigated, and the projects are generating predictable long-term revenues. We're generally secured by the project cash flows and material contracts, as well as the equipment. So that's what I mean by non-recourse. Often, we're not looking for additional personal or parent company guarantees, although in some cases that might be appropriate. In general, I mentioned we come in at construction financing, which means we're not typically looking to take on development risk. And so something Mike mentioned earlier about a potential role for his group would be coming in with some of that development capital to really help spur projects to get them to construction readiness. Of course, if projects don't fit into this project finance box, that's where we can come in with some of our more traditional financing products. Next slide, please. And I'll talk about that in a second. So this is actually some examples of projects we've done that meet this project finance criteria. And I wanted to share two brief case studies, the one on the far left and the one on the far right. And we're gonna have a whole bunch of new projects coming in the new year, which I'll be happy to share shortly. We have, of course, this is a subset of our projects. We financed over 1,650 projects across the country. And that's now generated over 18,000 tons of CO2 equivalent saved and counting every year. The project on the far left is residential geo-exchange in British Columbia. So briefly, what's interesting about this from an innovation perspective is that when it comes to saving energy and reducing emissions, geothermal is often one of the most effective solutions available to home and building owners. The problem is that it's expensive. A single residential installation can cost as much as $30,000 to $50,000 upfront. So despite excellent economics in that most homeowners will save money in the long term, few can afford geo-exchange, and the industry as a result grows slowly. So our client, TerraSource, and its parent company, Geotility, has solved this problem by offering geothermal energy in a utility model. Rather than pay for the equipment and the installation upfront, homeowners can now pay a fixed quarterly bill for heating and cooling services. TerraSource designs, installs, operates, and owns the exterior equipment, in essence, acting as a mini utility for each individual home. If this sounds familiar, it's because it's based largely on the model that allowed the explosive growth of residential solar in the US with companies like SolarCity and Sunrun. In lowering the cost for homeowners, Geotility, of course, is left footing the bill for these expensive installations. So CoPower was able to provide refinancing for almost 700 homes that Geotility had developed. And this freed up Geotility to take out some of their equity in those projects to invest in the next portfolio to bring more of these types of projects to market. In the far right case, this is a 16-story, 190-unit condo building. And this was the first multi-unit residential condo building in Canada to achieve the Investor-Ready Energy Efficiency certification from the Canadian Green Building Council, which is essentially like a LEED certification for retrofitting. The measures included here were heating, ventilation, and air conditioning upgrades, building automation systems, water fixture replacements, and lighting upgrades. And this project will expect to achieve about $73,000 a year in utility cost savings, which is about 25% of that building's utility costs. It reduces annual emissions by about 90 tons of CO2 equivalent. And it's repaid, our loan is repaid through the energy savings within 10 years. The condo had no upfront costs, shares in the savings, and is avoiding operating and capital expenditures to maintain or replace the aging equipment that our client now does. So similar to what I mentioned earlier in this project finance model, our customer here was Adesco, which is a third party that will own and operate this project. The loan is on their balance sheet, so it's not on the building owner's balance sheet, which addresses some of the concerns Thor had raised. And we think this makes it a highly attractive model for certain building classes. And the CAGBC certification program, I think, will allow us to develop more of these projects in a homogeneous way, which hopefully will make it easier to start to really drive down the transaction costs, increase reliability and confidence in the energy savings, and perhaps eventually look to securitize portfolios of these projects for secondary financial markets. Next slide, please. So I mentioned we also have a number of traditional financing products like commercial loans and mortgages. But even there, VCIB is looking to utilize these products to create positive impact. So we've created a green commercial mortgage and a green line of credit, which can be used to unlock some of these smart cost-saving building upgrades for building owners. So in the case of a green commercial mortgage, we can look at how the energy efficiency or on-site generation would actually improve the value of the building and reduce operating costs. And then we can finance that as part of your mortgage. And for the green line of credit, if the building owner already has a mortgage, we can offer this non-revolving term loan to finance these additional retrofit measures. Next slide, please. I won't go through this, but of course, these slides will be available afterwards for participants. So feel free to walk through this and get in touch with me at any point if you'd like to talk about some of your projects. And I think with that, we can hopefully move into the discussion.
Okay, thank you so much. I think what we should do is start with a couple of clarifying questions that have come up in the chat. And then I have a couple of questions I want to ask the two of you as well. There's just so much going on in this realm right now, and which is a great thing. And we're moving so rapidly. So let's start talking about some of the sort of topical things, particularly the federal climate plan. But a couple clarifying questions. First one, Thor, if you could maybe clarify the value of having the geographic concentration of buildings. I think there was just some questions on why that is valuable, and maybe you could just expand on that.
Good thing, happy to do so. If it's okay, I'm going to use a concrete example. When we're decarbonizing the electricity grid, like we are in Alberta, there's going to be a lot more intermittent renewables. What we're trying to do is just make sure that we are investing with renewables, storage, and efficiency at the same rate overall, so that it's less costly for us. If we try to just say nobody gets more energy efficient, we just get all the same energy now, but renewables, it's much, much more expensive. So transactive energy systems were designed to balance those loads so that you're a resource if you're conserving energy as well as if you're producing energy. So the easiest example is electric hot water tanks. They're the most common battery in all of North America. I think like 40% of homes have them. It's just a thermos, and it's 20% of a residential heating load. So 20% of the load, if it's in a transactive energy system, we charge this during the night when the wind is blowing before the morning peak. Because, you know, if you look at how our energy curve looks in residential market, it's really heavy in the morning when we shower and cook, and when we get home and watch TV and cook again, basically. What we want to do is take some of that load and move it to nighttime, and then not charge it until the sun is shining again, so it's ready for you when you get home. So just like by turning that appliance into a battery, we all of a sudden don't need to increase our peak and invest more energy than we thought we did. So how this plays out with geographic concentration is that, well, how far do we move solar energy and when? You know, it tends to be fairly local in general. So if we've got Alberta, it's going to be important that we have local resources that are working together as opposed to far apart. It doesn't really matter how much renewable energy is being produced in BC to groups like NMAX or ATCO. So the thinking there is what you actually need is enough buildings in an area that it makes an impact. A microgrid at the scale of a building can't influence the grid, not really. I mean, they can do it internally because they're worried about making sure their own machines don't burn out and whatnot. But taking one building out of a grid is kind of like unplugging one light bulb in a room. You actually need a lot of them so that we can actually plan. And then you can have energy resellers saying things like, I'm going to bid at the power pool prices at this rate because I know 20% of my load is actually going to be charged during the night when energy is cheap. And then we all get to benefit from it. Hopefully that was clear. The other example is just New York. The value of transactive energy services basically changes by almost a 5 square mile radius. The difference between them and us is they actually have incentives on top of that for offering those services. We have none. So we'd get the benefits overall, but the person who had the hot water tank wouldn't get that $100 check in the summer for that demand side response. So they said, I don't care, I'll cold shower this morning if you pay me $50 for it. We don't get that, not unless the province did it, unfortunately.
Thanks. I think that was the second part of that question too, is that we don't really have those mechanisms right now for the individual to accrue the benefit. Jonathan, question for you. You know, you talked a lot about green bonds, and CoPower really, you know, green bond company on steroids. So can you tell me what is the benefit there of a green bond versus just conventional financing? Like what's the difference here?
Yeah, I mean, I think that it's a very targeted way to raise capital. So you can set out these very specific objectives or metrics as part of the investment criteria, and then you can find investors who care about that. And with this massive shift in the flow of capital from traditional investments into green or ESG focused products, this is just one more tool in that toolkit to more effectively match investor and borrower needs to achieve objectives beyond simple financial returns. So I think if we use, you know, a deep energy retrofit, which might have a 30-year payback, that's very steady returns, that might be a great profile for a certain type of investor. Some investors are looking for something that's shorter term and they want that 5-year payback. And so this is, I think, about finding, you know, really just matching the right types of dollars with the right types of projects to more effectively channel capital to where it can be most effective. In the case of, and I should say that I think the quality and range of types of green bonds globally is pretty dramatic. There's a number of organizations that are working towards standardization, and we work with one. I forget the name offhand, but so, you know, I think there's still some concern about the potential for greenwashing, as there is with any type of ESG investment. So, you know, if you're able to look under the hood and see what are the actual projects that are being created here, and is there additionality? That's one of the key criteria in the CoPower Green Bond is, you know, would this project happen without us or what is the proceeds, if the project already exists, what are the proceeds being used to do? So I mentioned in the case of Geotility, the geothermal projects in BC, those projects were already existing, but we financed that enabled the borrower to then reinvest that capital in the next wave of projects. In the case of CoPower green bonds, it's also being specifically designed to broaden the investors that are able to participate. Historically, globally, and especially in Canada, the green bond market, and I think Thor touched on this, is basically being limited to large institutional investors. And I think that if we can get more Canadians benefiting from the energy transition, it will hopefully help broaden the general public support and awareness for the benefits of this transition. I think in general, thinking about carbon alone can get us so far, but thinking about all the co-benefits of this energy transition can get us a lot further.
Yeah, thank you for that. So yeah, I've had conversations with both municipalities on green debentures and creating a framework for that. And it always falls back on this, I can get a better interest rate though by not doing it. And what you mentioned though is it's not about access to capital and getting the capital, it's about allocating that capital in mission aligned and mandate aligned things. Okay. I really would like to throw a question to both of you. The federal government announced its climate plan last week. In my life, it's really definitely been one of the more progressive plans I've seen. It's definitely trying to strive for deep emissions reductions. A lot of government involvement in it, though. I'm just going to preface that a lot. So the federal government has announced, the suite of support tools in the renovation sector, including these $5,000 rebates for home energy efficiency retrofits, ultra low cost loans for residential upgrades. The administrator of that, I'm not sure yet if that's somehow going to be thrown to private or not. If the past teaches us anything, probably not. But and they do promise to mobilize a lot of money from the CIB. And the velocity of getting that money out is something the CIBC or the Canada Infrastructure Bank certainly hasn't done in the past. So really, really pushing the envelope on stuff. So do you have thoughts on these announced programs? And really, when you're responding, I'd really like to get your thoughts on the role of government in low carbon financing versus the role of the private sector. Maybe Jonathan, why don't you start?
Sure. I agree. It's really exciting to see this stuff come out. But announcements are one thing. Seeing the capital deployed and seeing the impact of that will be really where I'll be looking. But I think starting at a high level, I think there's sort of at least three things that are important in the nature of any of these types of funding programs. The first is that they crowd in private capital so that we can really leverage that government spending, hopefully many times over. Number two is that these aren't flash in the pan investments, but they really help to create or accelerate markets that continue to grow after the government capital is deployed. The third would be that it's focused on de-risking projects. And I think to your sort of latter part of your question, where's the role of government? I think in helping de-risk projects is critical through things like loan guarantees, enhanced grant programs, tax credits, which can really help projects become more viable so that capital can be deployed with the appropriate risk return for the private sector. But I think it's also important that this government capital is focused on the sectors where it is really needed and where the private sector hasn't been maybe as active. And that could include areas like low income housing or different parts of the capital stack. And Mike, you touched on this a little bit already, like financing a tranche in between equity and senior debt, where it's often difficult to sort of round out that full the full capital for the project. I do think that all levels of government should do whatever they can, but I think the approach I think is that it's not just about low carbon solutions; it's about all the co-benefits like job creation, addressing the affordability and equity issues, and then tackling resilience and our ability to absorb the impacts of climate change we're already feeling, like floods and more extreme weather. So I think we can accomplish a lot with this capital if we're thoughtful about it. And I think that means it takes a village, right? So there's a lot of other government agencies that can be effective here, whether it's BDC, EDC, SDTC, CRA, and of course the private sector has a central role to play. Banks like us, of course, we need to be focused on deploying capital to good low carbon projects. Project developers need to be out there creating new projects, and energy consumers, be they businesses, condo corps, even individual homeowners, need to look at what they can do to reduce their emissions. So I do think it's an all hands on deck, and I see this government initiative as that signal that it's time to act.
Thank you, Thor. What are your thoughts on this?
I mean, I'm a little excited. I like anything that's going for ambitious. I think, we've done a lot of things with rebates in the past, and they kind of have these boom and bust cycles. And you think back 4 years in memory where you had a NIPR grant you don't have now, and you're not a good place. So it's been very hard to get that acceleration and have it last after, in Canada in particular, partially because we're smaller. I think things like the carbon price are going to be very controversial, but that would really tip the economics towards investments in renewables and energy efficiency, if that has staying power. As towards the role of the Green Bank, their challenge is always going to be crowding in private capital, because we know when we map it out, the government has the least ability to scale with the energy transition compared to banks and securitized loan products, mostly because they pay for anything else. So when I first heard we were going to do $2 billion over 5 years, that's about $400 million a year. That's roughly proportionate to the amount you would expect the United States spends on energy performance contracts, right? And $4 to $6 billion per year. So I think that's where they got the target from. So for that to matter, to be moving the grid and not just displacing private capital, they have to have probably $800 million being deployed each year. Because if we're just being the bank and moving money through, Honeywell's and Johnson Controls, because infrastructure bank is small, they're going to put this money through private service delivery agents, then we've just done cuts and we haven't increased investment, and that'll be the hard test for them to hit. But I'm sure they're knowing about that and they're thinking about that, and they've got all these partners to help sort it out. And it is a good time for opportunities. I think we've got some staying power. I'm optimistic, I guess.
No, thanks for that. And you really touched on something too that's it's kind of been burning in my mind for a while. And Kate from FCM asked this question in the chat as well. When I look at LC3 and the Climate Innovation Fund and how it evolves, you mentioned displace private capital. The last thing we want to do, I believe, is displace private capital as LC3. So with all of these exciting things happening, and Jonathan, I mean, Vancity is doing some incredible work and has so many mechanisms and financial products and services. How do we find our niche? Like, where do you think LC3 should live in this world of finance?
Yeah, it's a great question. And I think the sort of two ways to look at it. One is that there's just so much opportunity out there that it shouldn't really be a problem. There's so much work to be done, given our starting point, and given the targets, the 2030 and the 2050 targets. 2030 in particular probably scares me a little more than the 2050 target. Because if we don't get on the right track sooner than later, that 2050 target is going to be really, really challenging. And as I mentioned, we're already feeling the impacts of climate change. So I think you said it really well when you opened up, Mike. You talked about follow the carbon. I think that's a great guiding light. And asking that question, how do we scale this from 1 million to 100 million? That's the same kind of question we used to ask ourselves at CoPower with every deal. So I think I would encourage your group to focus on deployment with immediate carbon benefits and those that create scalable platform opportunities. There could be a role for R&D and piloting of pre-commercialized technologies, and that's really exciting, and that needs to happen. So that could be one of the niches where, as I mentioned, one of our criteria for project financing is that it's a commercialized, proven technology. So if you guys can incubate a project, prove the technology out, and then it sort of graduates to a VCIB type financing, that's a service to the industry. At the same time, this could mean that you're just looking at projects that integrate existing proven technologies in a novel way. And this gets to some of the transactive power stuff that Thor was talking about. So how can we bring two different groups together? Maybe it's a rooftop solar company and an energy efficiency retrofit company to create a unique product that marries those two in a way that creates more value for a building owner than either of those two on their own. Even if those two companies were to knock on that same building owner and do their own pitch, can you work with them to sort of create a more integrated solution? But I think, focusing on the carbon, so we can, really start to have meaningful carbon reductions in this decade would be critical. When it comes to the, focusing on scalable platforms, what I mean by that is looking for investments that create highly replicable and scalable follow-on investments, where each subsequent deal isn't a whole new process. So you want to create sort of like a conveyor belt of projects. I'll use one example. We have a partner we work with that does energy efficiency retrofits in condo buildings. The first deal we did with them was a couple $100,000, because these retrofits in condos, especially if it's just lighting, I mean, they're typically small projects, 100,000, maybe even 20, 30,000. A big one might be 200,000. And it's just not very efficient to finance those one-off. So there could be a role for an LC3 center to sort of incubate a portfolio of these smaller projects up to the $1 million or $2 million scale, and then have someone like VCIB come in, take that out, and then scale it even further with our deeper pockets. So we did those first couple $100,000 projects with that LED company. Fast forward 4 years, we had done over 12.5 million across 400 buildings in 4 provinces. So that's the kind of scale that we can do, and it just got easier and easier with every transaction with that group. The trust built, all the legal work was basically done, and it was almost like a rinse and repeat process. And then something else we touched on, but I think it's worth reiterating, is finding your niche, not only in terms of the market or the sort of stage of a development or a technology, but your niche within the capital stack. So you've got typically senior debt and then equity, but I think there could be a role for mezzanine or junior debt, or sort of equity-like financing that has generally quite good return profiles, and could help round out the capital stack and support a project developer that maybe can't bring 20% of the equity to a project. So I think that could be another interesting niche that really adds value to the market.
Thanks. Thor, I'd like to get your thoughts on that too. Do you have advice for the LC3 network, and even right for the Climate Innovation Fund here in Alberta, given your experience in the Alberta market?
Yeah, it's such an exciting time for the LC3 network, and I'm kind of torn here, because you could basically do most things you wanted to. I think there is a lot of room for you to play in the capital stack at the building scale and get bought out by somebody with deeper pockets and have a pleasant return. And I think that would push you towards sort of the project level. My one concern is it's very difficult to do technology innovation at the scale of a building. You might be better off doing equity investments in companies offering service innovations if you want to make more things available. And I think there's lots of promise in that space to sort of act as the group who brings together disparate service providers who may not know, but they had a match made and happen, and help them catalyze on that first project in ways like that could really have an impact, because they really have a chance to be picked up and grow by someone else. And I don't know which is better, because it's early days so far, but you've got a lot of room to figure it out.
Okay, thank you. A theme that's sort of emerging in a few of the questions in the chat is this idea of weaving in the principles of justice and equity. And, Jonathan, obviously, Vancity, you're not a not-for-profit, so you need to make money, but there is obviously some mission goals there and mandate beyond that. But how do you get this idea of equity into the realm of low carbon financing? I just know from my own perspective, when you look at the models, this is not a game for just the middle class or the wealthy. the people that can afford the change. We need everything to change, complete transformation. So that means bringing up a whole bunch of people in our society that may not be, the people that access capital on a regular basis. So do you have any thoughts on how do we live that, and how do we walk that walk with respect to justice and equity in the low carbon future?
Yeah, it's a great question. And, it's something that Vancity certainly has a long history of doing, certainly in the real estate space with our focus on social purpose real estate and low income housing. I think that low carbon solutions can, if structured properly, create lower cost solutions. So I think they can help alleviate things like energy poverty. And my hope is that this is where some of this federal funding will go. So if we can channel some capital towards reducing energy costs in low income housing, I think that has an immediate benefit. And I think there's a workforce element to this as well. If we are to retrofit all of our buildings towards net zero over the next 20, 30 years, that's going to take a huge labor force. So I think there's a great opportunity for that for Canadians right across the country.
Yeah, though the idea that we can employ the underemployed and the marginalized in this revolution is definitely something that comes up as a theme as well. And Canada Green Building Council is doing some work on that too, and getting the workforce ready for the transformation ahead. Thor, do you have any thoughts on equity, and how do we make low carbon financing part of the picture with respect to justice as well?
Yeah, I mean, it's super hard to answer because equity is always going to be dependent on the people in the group you're dealing with. I think pursuing participation from the groups you're reaching out to first, and then having them decide whether this is going to be on the energy side through lowering energy costs or employment opportunities. I'm pretty sure they would be able to guide you there. Because absolutely, if we leave people behind in this energy transition, we won't get very far. And I don't think it will be palatable for many people. So I'm sure it's got to be number item 2 or 3 or 1 on most people's list at the CAGBC or the Canadian Infrastructure Bank. One good thing is that, if you wanted to look for housing stock, we do have social housing throughout the country, and it tends to be more energy intensive because it's always occupied because there's never enough rooms. So if you have a building that's always fully occupied, it really lets you help these groups, and they'll have a better return on investment than your average condo or your average apartment building. So I think it makes a lot of sense to really lead with some of these groups.
Thanks. I have, one more question, I think, and then I think we're probably gonna, if anyone has any other questions, please add them in the chat so we can ask the panelists of them. But again, I'm looking at the lay of the land and the cost of money right now. And I mean, the interest rates are, for a very long time, we keep saying they're at historical lows, and each year they become historically lower, it seems. So how do we like, conventional lending products are very accessible to most people, like HELOCs and things to do energy efficiency retrofits on their homes and things like that. There still isn't like this rush to do that though, right? So how do we compete with these other products when the interest rates are already so low? What's the magic there that we need to somehow make happen? Thor, maybe I'll start with you.
Sure. I mean, I know we always look at the interest rate, but it's kind of the tail wagging the dog. It's the principal that you feel and you pay down, that's really the cost that makes people say, I'm not going to do it or not. And that's not changed. And that's why when we had rock bottom interest rates in 2009, people didn't start leveraging up and fixing their homes. And they're probably not going to do that now because the total investment is large. So it's principal. On the low carbon finance side, usually the interest rates are higher than what you can get from the bank. Almost across the board, every once in a while you get specialized financing programs, and Toronto's like 2% locked in or something like that. But not very many people take it. It's 6% or higher in the US, but the reason is because it's being priced differently. The benefit for the financing and these mechanisms is that I could sell my building and not have to pay that loan down. And that's a principal question. That's way more valuable to them, not having to pay down all that principal at year 5, being able to recover some of those expenses from tenants that you wouldn't have been able to. Even recovering a small amount is important. You know, if it were me and I could step outside the interest rate question whatsoever, I think, at least for commercial real estate, a big reason you're not seeing lots of people take up even profitable energy efficiency measures is that we've got these lease structures that are locked in for 5 or 10 years. And tenants are not going to be happy if you renegotiate with them and say, hey, we've got this financing for you, but we're going to increase your share of the operating expense and you get the savings. That's very, very hard to do. So rather than tackle things like interest rates, I would go forward with things like green leases, which give you social acceptance to say, I'm happy to pay $2 more per square foot if you amend my lease, so long as you're furthering the cause to get our building more green, you know, and that's a way you could make it much more appealing, because then you actually can take on financing in that building and you're not competing on interest rates. I may have done a bad job of explaining that. I might have to
Well, thanks, Thor. Jonathan, do you have any idea?
No, I agree with Thor. I think that was well said. Rate, you know, when we're structuring a transaction, rate is one of many levers, and it's often a quite powerful one, of course. But you know, we look at leverage, rate, debt service coverage ratios, term, amortization, and there's a suite of other mechanisms that all sort of work together to create and optimize around the specific case and context. So certainly low interest rates, you know, are often, especially, you know, when it comes to consumer borrowing, are often mostly a marketing campaign to bring in new clients. You know, and to your point, we've seen significant rate compression over the past year, driven in large part by the pandemic and the economic crisis around it. But even just thinking about renewables, I mean, large scale wind and solar has seen significant declines in the cost of capital because it's arguably a mature market now. And so, you know, you were seeing, you know, 10 years ago, lenders were, you know, the rates for equity returns now are similar to what lenders were lending at 10 years ago. And that's just because people are more comfortable. It's a risk adjusted return. So yeah, I agree that it's one of these factors, and you know, I think around just the example of the homeowner who wants to do a retrofit, I think it's very difficult to even know where to start. There's very few sort of full building retrofit companies or contractors. You'd really almost have to call 5 or 6 different contractors and then pull together a solution. And most homeowners are not project managers. And that's really what it would take. So I feel like there could be a role for a municipally led or privately led energy concierge service that helps building owners navigate the solutions to pull together the right range of products. And I think in most cases, you know, capital is going to follow the projects. You know, if you have a well put together project, if you've really buttoned this thing up well and you've mitigated the risk, then you're going to unlock lower rates and better terms overall. If there's risk that's exposed because of the way the project is put together, then you're going to have a higher rate, or one of those other levers will change, the debt service coverage ratio or the leverage. So I think it's important to think of the suite of factors. But I also think it's important that, you know, while interest rates are at these lows, that we use this as a key moment in history where we've got the IPCC telling us we have 10 years to make dramatic reductions. Rates are at historic lows. The federal government is throwing money into this. The cost of solar has come down 90% since 2009. You know, the stars are aligning. And I think now it's really just incumbent on us as individual Canadians and as organizations to act. We really just need to start moving. And we can't wait for somebody to tell us how to do that. We need to start figuring it out. And I think that's one of the key roles of LC3s, and mission-oriented lenders like us as well.
That makes me just go back to the concept of an ecosystem again. It's really, financing is one piece of it, but we need to mature that ecosystem in Canada and particularly in Alberta. We live these ebbs and flows of government agencies coming and going and creating rebates and you know, the market has just been, it needs stability. And I think that ecosystem concept and the concierge service that you talk about would go a long ways. And then the financing comes with that. But anyway, I think that's where I'm gonna leave it. There were some unanswered questions, I think, in the chat. Everybody's gonna receive contact information for both Jon and Thor, so I'm sure they'd be able to follow up with you if you're interested. And I'm gonna hand it back to Vicky to close out the event.
Great, thank you so much. I just want to, of course, start by thanking everyone for being here today. And a huge thank you to Thor and Mike and Jon for talking us through these big ideas. And it's been great to listen and learn. Of course, we also want to thank our sponsors again, the folks who helped make this all happen. And again, we want to say a special thank you to Vancity Community Investment Bank for supporting this session in particular. And we always want to thank the environmental nonprofit and industry visionary partners that Alberta Ecotrust has that support so much of our work. And thank you again for joining us. This is the conclusion of the 2020 Environmental Gathering. So please, if you'd like to share something about your experience, the hashtag EcoGather20 is what we're using. And everyone will have indeed a follow-up email from us with the slides and recording and certainly contact information so that you can keep in contact with Thor and Mike and Jon. And you'll also be receiving a survey from us as well about your experience at the Environmental Gathering. So thank you so much again for being here, and we hope you have a great day. Bye, everybody.
Thank you so much.
Thanks, guys. That was great. It's Allison. Have a good day.
Allison.
Thanks.